The elephant and the stock market. Once upon a time, a curious traveler passed through an elephant camp and came across a herd of elephants. He noticed that the front leg of all the elephants were tied with just a thin strand of rope. There were no chains or cages. It was evident that the elephants could, at any time, break away from their bonds, but for some reason, they did not. Curious to know how such gigantic elephants could be controlled by just a thin strand of rope, he went to the elephant trainer and inquired him about this. The trainer replied, "When these elephants were young calves, we tied their legs with these ropes. At that age, the thin strand of rope was sufficient to hold them. But, as they grew up, these elephants got conditioned to believe that they can't break away from these strands of rope. So, till they die they get controlled by these ropes." The curious traveler was awestruck. These elephants could at any time break free from their bonds, but just because they believed they couldn't, they were stuck right where they were. Like these elephants, how many of us are stuck right where we are just because of a belief that we cannot do something, simply because we failed at it once before? Now, let's apply this lesson to the stock market. Amateurs, during their early stage of investment, naturally make a lot of mistakes. Once they incur loss, they never come back to stock market. But they miss the lesson that failure is part of learning in the stock market too, and that we should never give up. Let's see what common mistakes they make. Grab quick money. This is the biggest mistake that people make while investing in the stock market. People are always in a hurry to make money to become rich. This is the major factor that attracts people into the stock market. However, they don't understand that even Warren Buffett made the majority of his fortune after his 50s. Remember, Rome was not built in a day, but Hiroshima was destroyed in a day. Lack of patience. People enter the stock market to buy stocks which they heard on a news channel that it has a huge growth potential, and they invest heavily in it. They expect 2 to 3 times return in a short period of time. Once they lose money, out of frustration, they quit investing in stocks. This is how the non-achiever in the stock market thinks and loses money in the stock market. Remember, money gets transferred from the impatient to the patient in the stock market. Over-leverage. Leverage is an investment strategy where you can buy stocks using borrowed capital. Stock market leverage can increase your return on investment, but at the same time there are chances of losing money as compared to investing through your own funds. Leveraging gives more exposure to investors in the market by allowing them to pay less than the total amount of investment. There are brokers who allow you to trade as much as 100 times. Remember, leveraging is a double-edged sword. Trying to make money from the losing stock. It is quite common to make mistakes while buying a stock. Once you realize the mistake, accept and move on. Never try to buy the same stock at a lower price thinking that you can sell at a higher price someday. Never ever average the losers. Thanks for watching my video. Please like and subscribe to my channel. Click the bell icon to get new video updates.